Hello, my name is Trevor Baker, and this presentation will provide analysis on Company A's performance and operations in the 2018 business strategy game. This includes lessons learned from mistakes and accomplishments of the company over the years. Company A's mission is to provide high-quality shoe products, compete for global market leadership, and have fair wholesale and retail pricing while also increasing earnings per share, return on equity, and stock price. It is also important to maintain a positive credit and image rating while also showing a strong corporate social responsibility. This also includes creating a competitive advantage in the athletic footwear market. According to the text, crafting and executing strategy, one can create a competitive advantage by practicing a few different approaches, which include low-cost provider, differentiation on features, focus on market niche, and best cost provider. Focusing on a market niche included concentrating on a narrow buyer segment, out-competing rivals, customized attributes, and meeting taste and requirements better than rivals. Efforts were made by building plants in Latin America and growing a narrow buyer. Some of the decisions turned out to help, while others ended up hurting the overall mission. Net revenue stayed fairly even throughout the years 10 and 16, but dropped in year 17 to about $85 million. Earnings per share followed a similar trend and turned negative in year 17. The growth in year 12 to 13 was partly due to building operations in Latin America, but later turned out bad when the plant was sold off and more stock was issued. Return on equity met investor expectations in years 10, 11, and 13, but turned negative in year 17 due to stock issuance and neglect in the North American market. The stock price compared to investor expectations performance was disappointing. Besides a slight increase in years 11 and 13, the price continued to drop, reaching less than $10 in year 17. The credit rating started out strong in years 12 and 13 after paying back debt, but later took a turn for the worse when more debt was taken on. Loans were taken out while new plants were built, which reduced net revenue and increased the credit-to-debt ratio. The decrease in image rating can likely be attributed to less focus on energy efficiency and ethics training. Throughout the years, private label sales decreased, internet increased, and wholesale remained steady until year 17. Private label sales could have helped in the long run if using a correct strategy. Global market shares decreased almost every year, mostly due to attempts at a greater share in Latin America, which compromised sales in North America. Building new plants in Latin America did have success in increasing the market share, where private label sales reached 20% in year 11. Some of the success was due to sponsoring respected athletes in the area. After year 11, private label sales took a hit across all markets and never made a return, while internet sales dominated the latter years. Building plants in Latin America and not providing adequate resources showed to be costly. This took resources away from existing operations that could have been capitalized on. In the future, it may be beneficial to capitalize on private label demand and monetize the market interest to increase earnings per share, return on equity, and stock price for investors.